Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the fourth part on the series on the financial accounting ratios. Profitability ratios 1 of 2. Hope you will like, share and subscribe our channel. Profitability ratios 1 of 2. The 5 standard financial accounting ratios: liquidity, profitability, solvency, turnover and earnings ratio. Introduction. Profitability ratios are a group of financial indicators that are used to evaluate a company's capacity to create earnings compared to its sales, operational costs, balance sheet assets, or shareholders' equity over time. The ratios, although generally the higher the more favorable, provides a more clear idea of the company's standing when compared with competing companies on historical figures or industry average. Profitability ratios measure the company's use of its assets and control of its expenses to generate an acceptable rate of return. Overall profitability ratios are based on evaluating how well a company is utilizing its resources, that's assets and equity, to derive profits or generate returns and meet shareholders' expectations. A lot of investors use profitability ratios to assess a company's performance with respect to its return on investments. Internally, the company uses these ratios to judge its performance and uses it to make necessary changes to ensure better utilization of resources. A company's return says something about the profitability of the company. The return shows the correlation between the financial gains or losses of the company and the invested capital. Sufficient return means that a company is able to repay the invested capital in a normal manner. Again, the ratio here is often very industry dependent. The general rule of thumb is that companies that achieve more than 5% net return are now considered healthy. The types of profitability ratios: gross profit or margin ratio, operating profit or margin ratio, net profit or margin ratio, return on capital, return on assets and equity, cash flow, return on investments, DuPont analysis return. Gross profit ratio, calculated normally on percentage basis, also known as gross margin ratio. It shows the proportion of the profit after deduction of the cost of its revenues but before selling, administrative expenses and provisions. Formula: gross profit by sales into 100. Ideal GP ratio, generally above 35% but varies from industry to industry. In simple terms, a company's gross profit is the money it makes after accounting for the cost of doing business. Operating profit margin ratio, calculated normally on percentage basis, also called as operating margin ratio or net profit before interest and tax. Operating profit is the amount of the net profit minus operational costs, the cost of its revenues, selling, administrative expenses, provision, depreciations, etc., but before deducting interest and provision for tax. In simple terms, operating profit is the net income derived from company's core operations. Formula: operating profit by net sales into 100. Ideal 15 to 20% but vary from industry to industry. Net profit ratio, calculated normally on percentage basis, also called as net margin ratio or net profit after interest and tax. Net profit is the amount of the net profit minus expenses, the cost of its revenues, selling and administrative expenses, provisions, depreciation, interest and provision for tax. In simple terms, net profit is the net income derived from company's operational expenses. Formula: net profit by net sales into 100. Ideal 10 to 20% but vary from industry to industry. Return on capital. Return on capital refers to an investment's profit in relation to how much was invested. It shows how well a firm turns capital into profits, measures a company's net income relative to the sum of its debt and equity value. It is effectively the amount of money a company makes that is above the average cost it pays for its debt and equity capital. In order to calculate return on capital, you need to know a company's net income, its total assets, and its total equity. You then divide the company's net income by its total equity to get its return on equity. To get its return on capital, you divide its income by total assets. Formula: earnings before interest on taxes or capital employed. Capital employed formula: total assets minus current liabilities. Ideal 15 to 20%. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel, Accounts and Finance with FARSK. Thank you. Have a great day.